Welcome to Clayton Capital Insights and today's CFA Level I test prep session. In this video, we'll cover the first two topics from Quantitative Methods, interest rates and the time value of money, along with an overview of rates of return. So what's an interest rate? An interest rate, also known as yield, is a rate of return that reflects the relationship between differently dated cash flows. Interest rates can be thought of in three ways. Number one, an interest rate is a required rate of return. This is the minimum rate of return an investor needs to receive to be willing to invest in a potential investment. Interest rates can also be thought of as discount rates and opportunity costs. This is the value that investors forego by choosing a certain course of action. Interest rates can be thought of in a few different ways. Interest rates is what an investor needs for the investment to make sense. So when you think about an interest rate, it's the real risk-free rate plus inflation premium that's built in. There's also a risk of default and liquidity and maturity. So investors need premiums for all of these. The real risk-free rate is the interest rate for a risk-free security, assuming no inflation. The inflation premium compensates investors for inflation risk. Obviously, inflation erodes purchasing power. Default risk premium compensates investors for the possibility of the borrower defaulting. And then a liquidity premium is the return that investors will need to compensate for liquidity risk. Obviously, like a treasury bill is a lot more liquid than corporate bonds, some corporate bonds. So there's more of a liquidity premium for less liquid investments. And the maturity premium compensates investors for the increased sensitivity of market value of the debt to a change in market interest rates as the maturity is extended. And then here's a equation to help you remember the nominal risk-free rate and how to get that. It's 1 plus the nominal risk-free rate is equal to 1 plus the real risk-free rate times 1 plus the inflation premium. Now in practice, the nominal rate is approximated as the real risk-free rate plus the inflation premium. So if the real risk-free interest rate is 3% and the inflation rate is 2%, then the nominal risk-free rate is approximately 5%, or 5.06% to be exact. Now let's dive into holding period returns. Here's the equation for a simple holding period return. The return is equal to the price at time 1 minus the price at time 0 plus any interest or dividends that are received from the investment divided by the price at time 0. Let's take a look at a practice problem to put this formula to work. Suppose you buy stock XYZ for 100 and sell it for 110. You also received a $2 dividend. What's the holding period return? To solve this problem, you would subtract your purchase price of 100 from the selling price of 110 to get the capital gain of $10. You also received a $2 dividend, so your total gain was $12. Divide 12 by your initial purchase price of 100 to get the holding period return of 12%. Next, we'll go into three types of means you'll need to be able to calculate for level 1 of the CFA exam. The arithmetic mean is the simplest way to calculate an average. Simply add all the returns and divide by the number of outcomes to get the arithmetic mean. Suppose a mutual fund posted the following returns for the last 4 years. Calculate the arithmetic mean. To do this, simply add up the returns and divide by the number of years. In this case, the arithmetic mean is 13.25%. The geometric mean, or compound return, is a more accurate indicator of the growth in an investment portfolio's value because it takes into account the increased asset value at the beginning of each period. The arithmetic mean, on the other hand, assumes the amount invested at the beginning of each period is the same. To get the geometric mean, we would add 1 to the annual returns and multiply the values. We then raise the product of all returns to the power of 1 divided by n. The geometric mean of 12.59% is a more accurate measure of this fund's performance versus the 13.25%, which was the arithmetic mean. Next, we'll take a look at harmonic mean. The harmonic mean is a special kind of average that's super useful when you're working with rates or ratios, like price to earnings ratios. The harmonic mean helps when you don't want big outliers to skew the average. In finance, you'll often see it used for averaging valuation ratios because it gives more weight to the smaller values and keeps your analysis more realistic. Another common application in finance for the harmonic mean is dollar cost averaging, or finding an investor's cost basis. And according to the CFA Institute, unless all the observations in a data set are the same value, the harmonic mean is always less than the geometric mean, which in turn is always less than the arithmetic mean. Let's use the harmonic mean to find an investor's cost basis. Suppose an investor is building a position in Candyland stock. The investor buys $3,000 of stock when the stock is at $10 per share, $2,000 of stock when the stock is at $8, and $4,000 when the stock is at $7. What is this investor's cost basis? To find the investor's cost basis, add the sum of the investments, which equals $9,000. Then divide by the sum of each investment amount divided by the price paid per share to find the total number of shares purchased. The investor bought 1,121.43 shares for $9,000, which means they paid $8.03 per share. Here's another example of how to calculate harmonic mean using the price to earnings ratio for a group of stocks. The harmonic mean in this example is 12.5. Next, we'll talk about trimmed and Winsorized means. A trimmed mean and a Winsorized mean are both ways to reduce the impact of outliers on an average. With a trim mean, you literally cut off a certain percentage of the smallest and largest values before calculating the average. For example, trimming 5% from each end. A Winsorized mean is similar, but instead of removing those extreme values, you replace them with the closest remaining values within the range. Both methods make your data less sensitive to extreme numbers, giving you a more stable and realistic measure of the typical value. Especially useful when your data set has a few points that could really throw off the average. Let's suppose you have the numbers 2, 3, 4, 100, and 120. For a trim mean, if you trim 20% from each end, you drop the lowest value and the highest value, which in this case is 2 and 120. That leaves 3, 4, and 100 for your data set, and their average is 35.7. For a Winsorized mean, instead of removing the outliers, you replace them. So the 2 becomes 3 and the 120 becomes 100. Your new data set is now 3, 3, 4, 100, and 100, which averages to 42. Thanks for watching the video. Please like the video and subscribe for more CFA study material along with tips and practice questions. If you found this helpful, share it with a friend who's also preparing for Level 1 of the CFA exam. And don't forget to check out the other videos on the channel for more quick, clear explanations of key CFA concepts.